What if the chaos wasn't chaos at all? What if it was all part of a plan? In early 2025, President Donald Trump's aggressive new tariffs sent global markets into a nosedive. The move triggered the biggest market decline since 2020, wiping out trillions and sparking a whole lot of panic. Amid the turmoil, a wild theory started making the rounds. Was this all by design? Could Trump be intentionally crashing the market to finally get a handle on America's mind-boggling national debt? Let's break down the evidence for and against this pretty extraordinary claim. At first glance, you can kinda see where the theory comes from. By August 2025, US national debt had ballooned to over $37 trillion. For years, we've heard politicians promise to tackle this mountain of debt, but it just keeps growing. So how could tariffs and a market crash possibly help? Well, the argument goes like this. First, the tariffs themselves generate a massive new river of cash for the government. Projections from the Penn-Wharton budget model estimated Trump's 2025 tariff plan could raise over $5.2 trillion in new revenue over the next 10 years. With all that extra money pouring in, the government has to borrow less, which helps slow down the debt. Second, proponents of this theory would point to the bond markets. Normally, when stocks crash, investors run for the safety of government bonds. This flood of demand for bonds should, in theory, drive their yields down, meaning the government can borrow money more cheaply. And this isn't just some fringe idea. It's something Trump himself has talked about. He and his Treasury Secretary have repeatedly said that a primary goal for all this new tariff money is to start paying down the national debt. So when you connect those dots, a shaky market, a huge influx of cash, and a potential drop in borrowing costs, you can see how this whole theory took off. But that's where the neat and tidy story starts to unravel. When you dig a little deeper, the case for this being a deliberate strategy falls apart pretty quickly. First, and most importantly, there's zero credible evidence that the administration's goal was to crash the markets. The stated reason for the tariffs has always been about protecting American industries and gaining an edge in trade negotiations. Second, that whole idea about a market crash, making it cheaper for the government to borrow money, it's misleading. During the Trump slump in April 2025, bond yields actually spiked after a brief dip. It turns out crashing the market shakes investor confidence in the country's financial stability, which can make borrowing more expensive, not less. As of late August 2020, the 10-year Treasury yield, a key benchmark, was still higher than it was a year ago. Third, those big tariff revenue numbers are often presented in a vacuum. The same economic models that project trillions in revenue also warn that the tariffs will slow economic growth, increase inflation, and lead to job losses. The Penn-Wharton budget model, for example, projected that the tariffs could reduce long-run GDP by about 4% and wages by 5%. These negative effects would shrink the economy, reduce overall tax collection, and eat away at the gains from the tariffs. Plus, the administration has also pushed other policies like tax cuts that are projected to increase the deficit by trillions. That tariff money, even in a best-case scenario, would mostly just be balancing out new spending, not actually making a dent in the nearly $37 trillion debt. And finally, the idea that tariffs could ever fully replace income taxes, something Trump has also floated, is a mathematical impossibility according to pretty much every credible analysis. So, what's the verdict? Is Trump intentionally crashing the market to pay off US debt? All signs point to a clear no. While the theory is definitely intriguing, it looks like a classic case of connecting dots that aren't really there. The 2025 market crash was a consequence of aggressive, protectionist trade policies, not the goal of them. That tariff revenue is a major side effect, and while it's a lot of money, it comes with huge economic risks and is largely cancelled out by other policies. The administration's stated goals were always about rewriting trade deals, not engineering a controlled demolition of the stock market. The real story here is one of radical policy creating radical uncertainty. It's a powerful reminder of how actions aimed at one goal, in this case, trade leverage, can have massive and often unpredictable consequences for everyone. But that's just our take. What do you think? Are high tariffs a clever tool for debt reduction, or just a dangerous economic gamble? Let us know your thoughts in the comments below. And if you want more deep dives into the policies shaping our world, make sure to like and subscribe. Thanks for watching.